Ladies and gentlemen of the crypto space, we're live on a Friday, November 3rd at 11:32 a.m. This stream is consistent with a theme that I say often: cycles will cycle, and that financial markets are an extension of nature, of natural cycles, because everything that exists in financial markets is a manifestation of humanity. And we are an extension of nature, so cycles are inherently part of everything. What goes up comes down. What goes down comes up. Regression, mean regression, deviation from the average and return to the average. These are all pressures that are inherent in every system. So we can look at charts and we see these trends. We see how deviated we are from mean prices, from average prices, and we could get a sense of where things are going to head in the short, mid, and long term based on these prices relative to the average. And we have some interesting changes in market structure literally today and yesterday, and we see that in collateral markets, and we're also maybe seeing that in energy markets. Now, let's pop it over to the main screen. We'll take a peek at what I'm looking at. So over here, obviously, collateral markets are getting bid pretty nicely, whether that is a temporary mean regression on the monthly to 10-year time-weighted average prices, or we see a breakthrough and a continuation to the downside, and we finally get our cycle, which I think, I speculate that that's kind of where we are with regard to timing of things. Now, the whole system kind of gets a sense of what the governments want to do, or rather what they need to do. Now, we could zoom out a little bit to 2020, maybe more so end of 2021 and the start of the rate hike cycle. Now, the reason they hiked rates so fast is obviously because they have an interest. We all have an interest in controlling consumer price inflation, and circulating currency supply in the real economy was out there because of 2020 and everything they did. And why they did it is an entire conversation unto itself. But they needed to control the amount of circulating currency units in the real economy to control consumer price inflation. And the only way they could do that is with interest rates, and that destroys credit. And where are we? Credit is completely frozen. Collateral prices have significantly decreased. Therefore, the amount of debt that can be taken out, currency units that can be printed using collateral, has been significantly constrained, and consumer price inflation has come down meaningfully. Not going to get into whether inflation is bad or good and that entire side of the coin, and the fact that if it's still a positive inflation number, prices are never going back to where they are. Definitely not getting into that conversation. But a point that I'd like to make is that their fast-paced rate hike cycle is the first real strong, ferocious rate hike cycle post-2008. And they needed to jack rates as fast as they did to control inflation as fast as they did. And it's been 2 years since they started jacking rates, because they needed to get rates as high as they could before the refinancing cycle, which is 2024 at this point, with about 11 and a half to $13 trillion that will need to be refinanced in addition to whatever deficit spending occurs. So there's going to be a huge flood. There has been a huge flood of full spectrum treasury issuance. And next year, there's going to be a massive waterfall of fresh on the run paper, fresh on the run treasuries replacing existing collateral in the system. And they needed to get rates as high as they did to accommodate potentially what they have to do next year. Obviously, they want to keep rates high, but Treasury is going to scream the entire time, we don't want to issue long-dated treasuries at these rates. They want them to be at a more favorable rate because they run a business and it's capex versus income, fiscal spending versus tax receipts. So whether the Fed is going to be accommodative of that interest or not is another story. I don't think they are. I think they're going to want to keep rates higher, and they're going to push to have rates around 2.5%. And as you can see in this chart, we probably break down towards trend line, and we have a breakout, and we're literally just heading into retest. And look at that breakout, retest, higher high. This thing will take until 2030 to play out that very simple sequence of events, that causality, the trifecta of bullish confluence with regard to rates, that is. So I think that's where we're heading between now and like 2025, 2026, and then we finally get into that craziness heading into the 2030s. And we don't need to go that far out with regard to personal capital management. We could talk that conversation all we want, the end game, like everything gets demonetized in Bitcoin, and that is palatable in many regards. But what's the time horizon? A lot of shit occurs between now and then. And that's not going to do us well if we're thinking too far ahead. We want to understand the long-term directionality, just as financial managers say, have a 10-year plan, a 15-year plan, but you also need a 1, 2, 3, 4, 5-year plan because you got shit you got going on now. So you need to account for all these time horizons. So cycles will cycle at these different time horizons, and basically the data indicates from a collateral perspective, we may finally be getting into an increasing and appreciating collateral price directionality, which would be consistent with the need for Treasury to refinance as much as they need to refinance next year. It may be consistent with the frozen state of credit markets, and they need to finally unfreeze it. Otherwise, what the hell is going to happen with commercial real estate is a completely unanswered question. And the real economy is suffering, and people are completely tapped of liquidity. Tapped of liquidity as an individual basically means people are broke. And it's a whole conversation, brokenness relative to consumer prices, that's separate and apart. So that's where we are. And with collateral potentially reversing, as so many folks would like to think is the case with equity markets, the rate of return expected to be below interest rates, equity prices or equities, owning equities is not in a favorable condition compared to owning government debt. It's risk-free relative to the dollar, and you don't have the volatility at all of price point, especially from an HTM, hold to maturity type perspective. So this is the type of condition where broad equity markets risk off into bonds as per like a traditional 60-40 portfolio type of configuration, which is arguably dead in the water going forward. Yet another conversation to add to the list. But with collateral prices doing what they're doing and potentially reversing, my eyes are probably on energy. And with the real economy, credit completely frozen, collateral prices just starting to change directionality, liquidity has been constrained, like it's not growing significantly or growing exponentially. So even the financial economy is constrained, which is holding back energy prices. And obviously, the supply side of the energy equation is also manipulated with OPEC and what's going on in Russia, so on and so forth, and the deals we make with Venezuela. Iranian oil is only a small part of the equation, but all of this put together, it looks like they finally got the cyclical appreciation of oil under control, and we might be in a position for reversal. We printed this lower high if you inspect from a monthly perspective. You have this upper bound trend with the high set in March of 2022, the breakdown through the monthly TWAP, a breakout, retest, and it's a retest following a bearish engulfing candle on the monthly. So there is an expression of weakness here. And between now and the end of the year, the next 1, 2, 3 candles, you'd like to see this fall through the monthly TWAP. Historically, when you see oil down, it's a leading indicator on dollar down. Dollar down is a leading indicator on systemic liquidity, and collateral prices up is a leading indicator on systemic liquidity. So if the oil falls, the dollar should fall in the following 1 to 3 months, and collateral prices up, we should finally see liquidity significantly improve in the system in the following 1 to 2 quarters, 3 to 6 months. And where does that put us? So it's nice that this type of story that we're telling today leads into the time frame in 2024 where there's a shitload of refinancing requirements and they want more favorable rates. That's where we are. Look at that DXY finally coming down with a nice move, invalidation, bearish engulfing, retest, a breakout. Definitely didn't get the higher high necessarily, but you see why it's November. We really need, at least to the end of the year, another 2 months. We need to see what this bearish engulfing does. Does it close as a bearish engulfing? There's literally 27 days left in the month, so it's discomforting from that perspective, how much time we need to see a favorable candle. But what you really want is an invalidation. You want a breakdown through the monthly TWAP and to hopefully confirm a continuation to the downside. Do we get a very big move, something like 10, 15 points, and do we push below 100 and a close below 100? You get a close below 100 and a lower low and a confirmation below the monthly TWAP, then it's time for conversation from a 3-month perspective. And it's time for what the hell is going on relative to the 3-month time-weighted average price. And you get a breakdown and you get that type of conversation we just had from a monthly perspective on the 3-month perspective. And this is where big liquidity cycles come into play. Now, my perspective on crypto markets right now is from a flows perspective. And the primary argument there is like counterparty risk. Counterparty risk is significantly different right now as compared to as it's been in crypto cycles historically. It's a very different market, very different considerations. Never had treasuries depreciate like they've had at any point in history in the crypto markets. Now, what's very interesting, when you look at chart data from a high time frame, you could see very large events like the first 2 major crypto market cycles, 2017 and 2020. And it's right here. I've shown these before, but you could literally draw a simple circle and be like, this was the entire bull market, as people would call them, in dollar terms. And they occur when the dollar depreciates. Why? Because when the dollar depreciates, systemic liquidity significantly goes up. So we have potentially very favorable conditions for a dollar cycle. The dollar is long due for significant directionality reversal. Since 2008, it's been printing higher high after higher high and higher low as well. And that'd be nice to see a reversal, and there's a lot of things that support that potentiality, particularly what rates did. Rates broke the 41-year trend line of lower highs and lower lows. So why don't we get a nice directionality reversal for a couple of years? I've shown charts from a 3-month perspective on the DXY where we could have lower high after lower low on the dollar for 15 years. And that would be, a more long-term macro cycle. And you have your shorter term 1 to 3 year, you have your rip to the upside on the dollar, and then everything about Japan's equation gets scary again. But if the dollar starts to depreciate and capital flows back into Japan, their situation gets stable cyclically for like a 1 to 3 year period until all hell starts breaking loose again. My base case for 2024 is really the invalidation of a good part of investments in equity markets. I really think that is the largest driver going forward for capital inflow into crypto markets. It's flows rather than liquidity. Like in 2020, it was all liquidity driven. Nobody knew what the hell was going on. Historically, in crypto markets, it was just pure speculation on price point. There was no investment thesis. There was no market. There was no economy. But that's the case now. Back then, nobody knew. So it was all just malinvestment. People just throwing money everywhere, and that's historically the narrative for crypto markets. But that's not the case going forward. We have very much a vibrant economy with interest rates and yield all over the place, and these are very consistent with the way capital managers traditionally construct portfolios relative to cash flow needs and price appreciation speculation and risk versus or rather growth versus value, as they historically did with the 60/40 portfolio. But I think that construct is significantly changing. I really think we see a massive invalidation of malinvestment in equity markets, companies that shouldn't exist. All that capital, trillions of dollars of capital in equity markets based on 0% interest rates, debt refinancing, and just constantly rolling it over. And that's all gone in a higher low, higher high interest rate environment. If we bottom out at 2.5%, everything about the equity markets is going to be different, not destroyed, but different. And different going forward means capital flows in different places. So I just have a very high opinion of these investments in crypto markets as compared to equity markets. And I'm having less and less of a good feeling about my equity market exposure. I'm not at the point where these particular allocations I have are invalidated, but I just see these financial economy centric enterprises in crypto markets as being such a more interesting investment heading into a world where we have higher lows and higher highs on interest rates. The financial economy will expand much more than the real economy in the coming years because the financial economy, they go hand in hand. You need both economies for the system to continue, but you get much less bang for your buck with debt financing going forward. It's like GDP. How much fiscal deficit do you need to have to create X amount of GDP? And there's plenty of economists that have talked about getting less bang for the buck going forward. Therefore, the financial economy should expand much more than the real economy in the coming years, and therefore more liquidity. And this is a pure expression, not this chart, but plenty of charts we look at are a pure expression of enterprise that are tied to financial market liquidity, such as Curve and plenty of others, because we're starting to get into new stuff and what's going on with Butter and what Aura's playing with, and there's some new protocols coming online that are quite interesting, and Frax still has yet to step up to the plate. Prisma just launched and caused a huge amount of financial activity. There's more Federation partners coming online for Curve, and this is going to be quite an interesting cycle coming up. So we started the stream with the imagery of circular flows and what happened. So we talked about circular flows from a macro perspective. How about the damn circular flows from inside of the crypto market perspective? We literally see that all the time. That's when capital goes to the yield. The yield is 100%. It gets diluted. Then capital flows somewhere else as the yield goes down to normal ranges, 10, 15, 20%, and there's a lot of outflows. So the capital is circular, and that's velocity, the movement of capital in search of yield. And this will continue to occur as new protocols come online, and this creates an attractiveness which draws capital into these crypto markets searching for yield. And as more and more time passes and these enterprises are shown to be stable and have longevity. Why would they have longevity? Because there's no humans and it's just pure software. So that's why capital's going to come here. It's such an attractive emerging market that's going to garner flows and not just continue to be degenerate because liquidity is flush throughout the system. I really think these government agencies are going to try and really constrain liquidity from reemerging in the real economy. They want to keep it in the financial economy, which is very consistent with the historical, I've used that word a lot this stream, tendency for markets to enrich the rich. The rich get richer, the poor don't go anywhere, and that will lead us to the great disparity. They can't allow liquidity to reemerge in the real economy in excess in any regard because that's a consumer price inflation issue. Therefore, it's a political issue. Hey guys, Bill Clinton's in the house. Hey Cap, been meaning to ask for weeks now, but never able to catch a live stream. Be cool to have a stream going over all your charts and how they help you parse information. I hope that helped. That was a decent introduction into the way I look at things. Gas prices are a leading indicator of oil prices. Oil prices are a leading indicator of the dollar. The dollar is expressive of a good part of global liquidity because it's the denominator. As the dollar gets cheaper, foreign fiat is more valuable, therefore it has more purchasing power, and every country around the world has a printer for their respective currency. Therefore, as the dollar comes down, systemic liquidity increases. And that is the case as well for the long end of the bond market. U.S. government debt is used as collateral around the world, especially in the Eurodollar market, leveraged, rehypothecated, whatever, 10, 100 times on the money. So as collateral prices rally, as bond prices go up, systemic liquidity increases. Dollar down, bonds up, one to 2 quarters later, and you're going to have a liquidity flood throughout the system. Cal, yeah, I am a bit of a deviant, contrarian to say the least. Excuse me. Sergio, present, Tapsy, yo, Captain, market enjoyers. I mean, look, we're kind of starting to see the interest come back. Now, a lot of folks that follow me, and especially the folks that have remained on Discord, we've been here for years. We're not going anywhere because we understand cycles will cycle, and it's part of nature. Therefore, it's part of this economy. Therefore, how do you measure success? How well you're doing with your portfolio, and how do you do that from a contrarian perspective, not necessarily from a degenerate perspective? Did you turn 100 grand into 50 mil? All right, that's cool. One, did you keep it? Two, was there a narrative, or was it just some sort of like shallow hodl methodology? Or do you really have a story? Because we also have dinner table investing to consider. You have to be able to tell a story about what you do and why you've done it, and then it really has meaning. Then it's a good history. I did this because of this, and this, and that is why I achieved this. And that's a good dinner table story. And that allows you to have something to educate your children about, because you have rules and methodology and standard operating procedures and stuff like that. And you know, it's so important when you're engaging with your own capital. You want to have depth. You want to be rich with the way you're able to describe to people why you've done what you've done. Because if it's just some bullshit story, like I bought a meme coin, it's just a bullshit story. It's nothing more. Because money doesn't mean much unto itself. How you manage it, what you do with money, that's how you really define your life. Scott, is Ren still alive? I think so. I kind of have it as a punt. I think their foundation is very much there. I think there's plenty of software. I think there's plenty of reason for it to reemerge in some shape or form. And I think there's plenty of room in the market. I think threshold is great. I think WBTC is significant in regards as compared to like a purely decentralized implementation like Ren was, other than the Alameda connection. I think there's very much room in the market for a product. I'm very interested in EBTC, a pure synthetic, a Euro Bitcoin, so to speak. That's a big deal, and there's only one protocol that's even trying to do it, and that's Badger. And that should be interesting. There's no token, so it's not like there's anything to capitalize, but from a product perspective, very significant to what historically is a meaningful component of the overall financial system, is the capacity to collateralize something and print a synthetic version of a unit of account. That's quite interesting. Um, so it's not alive right now, as in Ren is appreciating or it has a product, but I think it's interesting. And for myself, I had my nodes all those years. They were productive, and I just have it. So it's not like I don't know if I would consider taking a position currently. So the only reason I still have that as a position is for historical reasons. Quite the same way I describe my old school Cosmos position. But that's actually probably going to turn out quite well in the coming years, as we've seen with Solana. And I think Cosmos has quite a significant narrative, especially out in the East. And I've talked about those narratives, the China narrative, the India narrative, and I think those are still very much in play. Dan's in the house, a pleasure. Larson, thoughts on VLCVX versus VCRV, given the sheer amount of gov votes Convex has? I think the same thesis is the case. I don't see an invalidation of the thesis. I think there's going to be very little VECRV in retail hands that can be rented. I think the vast majority of the ECRV will be controlled by Convex. Great, there's a lot of voting capacity, therefore Convex gets a lot of interest with regard to vote rentals. But I think because of the scarcity of the ECRV, there's going to be a fair amount of capital. Now, why would folks rent from VCRV if you get much more bang for the buck? Like, you get so much more bang for the buck from Cleaver. Because they've accumulated concentrated CVX. So because it's there, it's a product, meaning if you're renting from CVX or you're renting from an accumulator of Convex, that's one market. So as this overall emerging market just explodes with the financial activity in the coming decade, if you make it, they will come. It's that old adage. So if it can be rented, it will be rented. So my hypothesis is that VECRV at the retail level will be relatively scarce. So it should do just as well as a CVX and a derivative of Convex with regard to vote rental cash flow potential. That's my speculation. Maybe that's a bias because of the position and portfolio structure I've chosen to have over the years, but I feel comfortable with it, and I think it's reasonable. It's definitely rational. Question for you: looking to place my Convex somewhere and struggle to understand all these options. I will express what's important here in the context of this type of stream and the way we talk. Don't struggle. Vote lock Convex, and you get rental income, which is 20% or whatever the hell it is right about now. So that is a bit of it's unexpected that many new participants in the space will be like, how do I get 50, 100%? Or they try and outperform, and that's not what we do on this stream. We want to be boring. We want to be passive, and we want something that's real, something that has longevity. It will continue to exist for 10, 15, 20 years. Now, 20% in DeFi terms is freaking boring, but in traditional finance, it's unheard of. You're not going to get that in equity markets unless it's a company that's paying unsustainably. But in crypto markets, it's obviously sustainable, and it'll probably get diluted in the coming decade, but by then, if you get 20% on Convex now, and Convex goes 10x on the money, 20x on the money, and gets diluted to 10%, okay, I'm pretty sure that's pretty good. So that's a good part of my base case as well. I expect yields to come down in the coming cycle, but I expect significant principal appreciation. So just like I said, if Convex goes 10, 20, 30, whatever X on the money, and it's still cranking out 10, 15, 20% yields, That's extraordinary from a revenue perspective. Now, that'll be quite disappointing from depending on portfolio size. $1,000 isn't going to do much. $10,000 might not do much, depending on expectations. Setting reasonable expectations is another part of the equation. This is not the alpha channel. This is very much the survive channel. Now, that's going to be an interesting thing to say during a bull market. We're here for survival. But that's the way I will continue to be. And I will continue to try and be passive because we want to do no work here. So everyone's going to be degenerate. There's going to be a frenzy of activity. What's to buy? What's going up 1,000x on the money? And we're going to be, is it Thursday? Did we get paid yet? And I, likewise, because of the way I talk, many other people are probably subscribing to this methodology as well at this point. I look forward to a different measurement, the revenue, the weekly revenue. I look forward to the revenue cycles. And that chart, revenue will double, it'll triple, it'll quadruple. And when revenue goes up 10x on the money, that's cool. And we want X, Y, and Z. We want to buy revenue because revenue is income, and income is equivalent to employment. Because instead of trading time for money, we want to buy a salary. This is some historic talking points, and it's always good to rehash them, but I very much look forward to revenue going up. I don't really care much about the principle. It's nice to look at, whatever portfolio manager you look at and you see your portfolio going back, and I think you're going to go way past all-time highs of 2021. Raul says very nicely, the whole space goes 100x from here, and I think that's quite reasonable. I don't expect Curve to get 100x on the money, but that's not what I care. I care about the cash flow. If the cash flow goes 5x on the money from here, 10x on the money from here, do you give a shit about your portfolio? But obviously, if your cash flow goes 5x, 10x on the money from here, your portfolio is going to go up some nice multiples as well. So that's pretty much where I think we're heading. Definitely not looking for Dogecoin or Pepe to turn $1,000 into 20 mil. That's just not what I'm here for. Hope that helps. To many new entrants to the space, that might be disappointing, and it's not the channel for many persons, but for the older person, for the 30, 40, 50-year-old, this is probably what people want to hear, and I will continue to cater to that kind of market because that's obviously what I'm looking for. I'm not looking for degeneracy. Minimize gas fees, do less work, vote lock, call it a day. It's as simple as that. It'll probably expect it to underperform. You're not going to do crazy shit, but that's the whole point. You're going to have new protocols come online, or that are going to be accumulating convex, that are going to be accumulating curve. They suck up circulating supplies. The whole federation conversation. It's going to become increasingly scarce. Therefore, it'll appreciate. And therefore, the capital, the velocity through the space with what Prisma does with its stablecoin issuance, with what CRV USD does with its stablecoin issuance, with what Frax does with its stablecoin issuance, the liquidity in the space expands. And when liquidity expands, it looks for activity. It searches for yield. It searches for investment. And all of that reduces to FX, foreign exchange, which are the AMMs, which are the exchanges, which are fees. And when you start an enterprise, you need liquidity, otherwise your token does nothing. So they need to finance the liquidity, and there's our revenue. So that's how it all relates to the activity that we want to be exposed to. We don't need to be exposed to the degeneracy, because the degeneracy is going to finance the transaction fees. The degeneracy is going to finance the enterprises that need to finance their liquidity depth. So we are indirectly exposed to all of the craziness that crypto is well known for. Hope that helps. What are your thoughts on Prisma, potential buy market for LSDs? I look forward to getting that drop. What's nice is that airdrop is in locked. Prisma, CVX Prisma, which entails it's locked, so it's not income. So I could handle that from an accounting perspective very easily. And I think the revenue is going to be interesting. Uh, I think uh, I think that's going to be interesting. In any case, that's the only path. I'm not going to claim it. I'm not going to sell it. That makes no sense. There's no long-term thesis there, and I want income anyway. I don't want a capital gain. So I say this with sentiment like, all right, probably going to get some extra cash flow out of that bad boy, and that's nice. Kaizen's in the house of pleasure. Leonardo, Cap, pancake swap partner with Aura to make the cake. What do you think about the movement? Uh, that's cool. Aura knows what they're doing. Balancer knows what they're doing. It's probably going to cause a lot of financial activity. Pancake swap is high on the list with regard to volume. So I think it will be quite significant. The question you have to ask yourself is just standard portfolio management, diversification versus concentration, counterparty risk. What kind of exposure do you want? Do you want exposure to Binance Smart Chain? And for myself, the answer is simple. I don't want exposure to BSC. I want the capital returns, but I just don't want that kind of exposure. And for me, that's the easiest way for me to invalidate even thinking about it too much. It'll indirectly affect the entire space. It'll indirectly cause returns everywhere to what we have exposure to. Everything is connected, and that's a required observation of financial markets. Everything is loosely connected to everything by a endless cyclical knock-on effects. Um, Bill, also since I'm here, what are your thoughts on Sam being found guilty? Uh, uh, that was a bad boy. He didn't know what he was doing. It's negligence and fraud in a court of law. Man, bad. Listen, a jury concluded that was the verdict. I'm not one for opinion, meaning I don't share my opinion much. I don't like to be partisan. Um, but I try and think from his perspective as well. But he just maybe didn't realize what he was doing was so bad, and then that's some sort of psychological deficiency on his part, and there's consequences to things that transpired, and now he's dealing with those consequences. George, hey guys, Noah, did you take a look at Prisma and their protocol? Yep. Look forward to the drop, and I look forward to the extra cash flow. I think it's going to be interesting. I don't borrow money, so I don't borrow, MKUSD. I don't borrow CRVUSD. I don't borrow money, but I know that's a product that I want to make money from. So I like that product. I like that Prisma, one of their core tenets is immutable. It has been deployed. It is done. So I'm pretty sure they took a page out of a lot of experience, a lot of the actors like, Michael and Tetranode, and there's a reason they did what they did, and I think it's going to be a nice component to the Federation and drive a fair amount of velocity, financial activity. Have you looked into EQB with Aggregator and Pendle? No interest. Pendle is an interesting product, but it's not something I would be tempted or interested in. It's a product for the masses, and I could care less. In the end, all of that drives flows and velocity through the system, so that's where we get our fees from. So that's cool. Boosted Pendle is coming from the Pendle accumulation or Equilibria Finance, which is converted by the Pendle holders. Cool. It's a downstream product from what should emerge as the base layer of market activity. The fundamental market makers, the base layer AMMs, and that's cool because at some point everything becomes an aggregator. was that seamless cross-chain liquidity narrative from 2021 we talked about all those years ago. At some point, you go to 1 inch. You don't have to select the chain. It doesn't matter. And when you do a trade, it goes through every chain. And the liquidity is seamless on all chains. And you're getting the best price from all liquidity on all chains. So at some point, it doesn't matter. And that applies to all the AMMs. Like everything just becomes completely seamless. So all that matters to me is owning the base layer. That reminds me of like first gen card games. You own a bunch of alpha Magic the Gathering, or you own a bunch of like first gen Gods Unchained. You own the base layer. That's what becomes the most meaningful. And I don't have a short-term time horizon, so I own the base layer, and I look forward to that hindsight perspective in the year 2030, in the year 2035, in the year 2040, and I think these will be looked at as good choices. Iden, who is eligible for airdrop? Unless you voted from a VECRV position or a VLCVX position, uh, or you got points from borrowing MKUSD. On the Prisma Twitter X handle, they have some Medium documents that describe who gets the airdrop. Diesel, he didn't know what he was doing. Shell companies didn't know what he was doing. He didn't. He had no idea what he was doing. The guy literally had one of the best money printing businesses probably in history. He was so wealthy on paper, and he couldn't fucking open QuickBooks. He couldn't just literally manage the books like a grown up. It is the biggest bag fumble, the biggest fuck up of one of the biggest opportunities I could possibly think of. How do you drop the ball so bad on such a potentially incredible business for the next decades? What a jerk. And now there's consequences. Crypto Jake, good morning. Kaizen, tapioca's coming. Immutable. I like immutable. I like that I could check back at 2035, and if Ethereum is still here, it's not even Ethereum. We're talking about EVM. We're talking about probably one of the biggest things in the future for Bitcoin. Yeah, Ornos are cool, but that's from an NFT perspective, and what are you encoding? So like data storage and stuff like that. But I'm really interested in Bitcoin securing an EVM. It doesn't matter if it's EVM on Ethereum mainnet or EVM on a rollup or EVM on an Alt L1. EVM is EVM, which means the code that has been deployed can be deployed there, hopefully with minor to no modifications. So, you know, pick an EVM secured by Bitcoin, Syscoin, or what have you, Rootstock, or whatever picks up, or one of the roll-ups that they're building, an EVM roll-up, if they eventually get it and liquidity flows. All that matters is where the emerging market is. And an emerging market is a classical definition based on dollar liability capture, currency unit of account capture, velocity, currency growth, currency expansion, productivity, and whether it happens on Bitcoin or whether it happens anywhere, that's what we're here for. We're not here for a savings technology. We talk about that with the cash part of the portfolio. How do we save capital and manage cash? But we're investors, so we're looking for enterprise that is relevant to this emerging market, an emerging market in the financial economy, and it's global. So that's why we're here. Iden, you're very welcome. I've had curve up this entire time. Finally back up to 52 cents. Very nice to see. Cash flow is still there. It's come down. October was one of my lowest months in the last 2 years with regard to revenue. I hope October gets a little bit better. I think October is going to beat out I think November is going to beat out October a little bit, and I think we're finally getting to bottom with regard to on-chain activity and cash flows. I think. But we see that with Bitcoin and Ethereum. I think these are forward-looking indicators on velocity in this emerging market. As these collateral prices appreciate, these are leading indicators of currency expansion and activity, velocity. So Ethereum is over 1,800. It's still the downside of the 3-month time-weighted average price. What we're at is identifying the end of the cycle. A cycle of capital contraction, a cycle of depreciation, a cycle of outflow versus inflow. And at some point, probably in the shorter rather than long term, probably towards the end of that cycle, we start to see inflows, a return to a positive sum environment, a return to leveraging, capital expansion, liability printing, and a return to appreciation of these fundamental collaterals, these primitive collaterals, Ethereum and Bitcoin. It's a heck of a price, and this is above the 3-month time-weighted average price. Ethereum has yet to move. These all will move. And which one outperforms? I don't give a shit. All I care about is them appreciating relative to the dollar. Because when they appreciate relative to the dollar, that's going to drive capital inflows. It's going to drive a positive sum environment. And that's going to drive fees. And that's going to drive enterprise formation, capital formation, as the SEC talks about. And that's going to drive incentive systems. And that's going to drive these enterprises to need to finance the liquidity depth. And that's where our revenue comes from. So this is the bottom. This is the start of that cycle. And we're almost there. Total crypto market cap is finally inching back above the time-weighted average price. And collateral's rallying. So you look at the real-world collateral, real-world financial economy collateral. And it's getting there. And oil is finally showing weight. It feels heavy. It is a lower high. It is trying to retest the 3-month time-weighted average price. And this is a 15-year wedge. So this cycle, we have a lot of cycles before any of those narratives about the end of something. I don't know. It's crazy shit. The end of the dollar, the end of... No. It's 8,000 days, 8,600 days left in this damn cycle. Cycles are going to go on for many, many more years, and they're going to get more perverted as time goes on. Japan is going to get so perverted with their currency and their bond market, and the U.S. and the national debt and the Fed balance sheet. It's going to get perverted, and every cycle, people are going to say, oh, it's the end. How do they have $50 trillion worth of national debt? And how is there $20 trillion on the Fed balance sheet? It's going to be perverted, and it's going to seem gross, and yes. And what's your weekly paycheck like, and how is it relative to consumer price inflation? So this market, the crypto market, is going to expand relative to systemic liquidity. This is the best expression of a capacity to keep up and deal with and outperform consumer prices. Equities aren't going to do that. S&P is going to go 1 for 1, and that I firmly align with the way Raul talks about. S&P barely keeps up with global M2. It's basically 1 for 1, and then NASDAQ outperforms. But I don't. That exposure is shit because there's no revenue, there's no cash flow. It doesn't do anything for me. So that's the deal. That's where we are. And I hope that helps on a Friday, gives you a comforting weekend. You could watch Bitcoin go crab walk between 32 and 35 for the next 3 months. And that'll be a hell of a thing to watch play out in technical data. That'd be lovely to see complete horizontal price action for the next 3 months as people start to digest that collateral prices are finally reappreciating. And then before you know it, the flood of liquidity happens in meat space, and the dollar rolls over, and oil rolls over cyclically, bound to reverse to the upside. But before the dollar reverses back to the upside after an inevitable fall, before oil reverses back to the upside after a cyclical fall, the liquidity expands and the crypto market will do what we want it to do for us. Thank you all for joining me today, Friday, November 3rd, 12:22 p.m. Tell everyone to subscribe. We do better together. In the description is a link to the most rational community in the entire crypto space. Thank you all for sticking with me, and we'll do well in the coming years. I will see you again next week. Peace.